staff who's not compensated by the organization, either as an employee or as an independent contractor, and who would meet this standard of independence. So what does Schedule L do? Schedule L is a very complicated report that you file, and it requires a variety of reporting. It is also key for identifying financial thresholds for financial transactions, and provides a definition, or I wouldn't say a definition, multiple definitions of who are disqualified persons, and those definitions relate to each type of transaction. It's also, as we said, key for this independence inquiry. So this is a quick walkthrough Schedule L of IRS Form 990. This first part relates to excess benefit transactions, as Lucian described in the first part of his presentation. Sorry. This was, I think, pretty well described before. You've got an excess benefit, you've got an interested person, you're supposed to describe it, and then you're supposed to describe if there was any tax imposed and whether it was reimbursed by the organization. So if you unearth, oops, I'm sorry, I have done something. There's that technical glitch here. Part 2 relates to loans. And loans include salary advances. So if in fact there has been a loan between the TEO and the interested person, that needs to be disclosed. If it's outstanding at the end of the tax year. Part 3 relates to grants of assistance. And what that relates to is scholarships, fellowships, internships, prizes, awards, any awarded during the tax year. And it includes family members as interested persons, so and substantial contributors. So in other words, if individuals have been, interested persons have family members who are interns with the organization, that type of thing, or have received a scholarship, that would render that person or that transaction disclosable on the Part 3 of Schedule L. And lastly, and this is the one of the most focus for us, is there are certain business transactions involving interested persons that have to be disclosed. And this is the part of the IRS form that describes it. If you go to the instructions for Part 4, you realize it's a very complicated set of reporting requirements. First of all, the transaction has to exceed certain reporting thresholds. First of all, if it's a payment to a larger organization, all payments during the tax year between the TEO and the interested person must exceed $100,000. And that includes contracts of sale, leases, licenses, performance of services, and it relates to the year that the amounts were paid, not when the services were delivered. When you look at the second threshold requirement, it's all payments during the tax year relating to a single transaction which exceeds the greater of $10,000 or 1% of the filing organization's total revenues. So again, these standards, these thresholds, try to get at the magnitude of the relationship of the business transaction. It's not any business transaction. It's a transaction that meets certain magnitudes. I think the second one, although I'm to some extent speculating, relates to smaller organizations. Number one, I think, catches larger organizations in its web in terms of you might have a contractor that provides multiple services over the course of the year and eventually gets to above $100,000. So if you have $100,000 in combined transactions, you meet the financial threshold. With number two, it's one single transaction, it's the greater of 10% or 1%. So I view it as something that really catches organizations that are $1 million or less in revenue and have somebody who has a $10,000 contract out there. The third item is compensation payments during the tax year by the TEO to a family member of an interested person in excess of $10,000. So, and that doesn't have sort of an organizational size attached to it. If it's in excess of $10,000 and it involves a family member of an interested person. Lastly, the IRS deals with joint ventures in which both the interested person and the TEO have invested $10,000 or more, and it doesn't matter whether it's in the course of the tax year. It matters in the commentary whether or not the TEO and the interested person both have 10% interest in profits or ownership interest. There's also a complex definition set forth for interested person, which again has to be funneled into this definition of what are the thresholds for reporting. So a family member of a current or former officer, we think that current or former officer relates to just the officer component of that sentence, but it's not clear from the directions. Director, trustee, or key employee. So if you are one of those individuals or you're a family member, you are included in the concept of interested person. It also catches entities that are 35% or more owned directly or indirectly, individually or collectively by one or more current or former officers, directors, trustees, or key employees or their family members. Lastly, it includes entities in which a former or current officer, director, or key employee of the TEO was serving at the time of the transaction as an officer, director, trustee, key employee, partner, or shareholder in all cases with an ownership interest in excess of 5%. So any of those positions, if you are an officer, director, or key employee of the TEO, and you are also serving at the time of the transaction in one of those positions that are listed below, you are an interested person. And I think this gets at something that was discussed earlier, the concept of interlocking directorates, interlocking relationships, where in essence you have an organization, the tax exempt organization is contracting with an entity, and there's a key member of either the management team or a director that sits and has an interest in that organization. So to bring it down to size, I put some examples up for you so you can kind of see how it works. And again, I think that this definition will be fleshed out more over time and probably refined. But let's just go through the examples. If there's a family member of a current director of the TEO who serves as a part-time employee of the TEO and receives $15,000 in compensation, but that $15,000 is less than the 1% of the TEO's total revenue, is that a reportable transaction? And the answer is yes, because the TEO's compensation to the family member exceeds $10,000. So that director becomes non-independent under the standard given in the directions. Example 2, a child of a current director of a TEO is a first-year associate with no ownership interest at a law firm that the TEO pays $150,000 to during the tax year. Is that director independent? And the answer is yes, because the child has no ownership interest and is not an officer, director, or key employee of the law firm. Number 3, the facts are the same as number 2, except that in this situation, the child of the current director is a partner and has an ownership percentage of 5.25% of the profits. And in that case, the ownership interest tips the scales, and the child, because of their ownership interest, renders the director non-independent. Lastly, in example 4, we have this former CEO, and remember the language we identified in the 990, former or current officer. We have the former CEO and one of the current directors of the TEO investing in a medical device, and together they own 45% of the company. The company sells a medical device to the TEO for $105,000. Again, yes, thresholds exceeded, and the entity is owned more than 35% collectively by this former CEO and the current director. So that gives you a sense of how it's looked at and how it's analyzed. We wanted to touch quickly on how this concept of independence relates to conflict of interest. And I think of it as two kind of overlapping circles. Someone could be independent and not have a conflict of interest at a specific moment, and a different person could have a conflict of interest but might yet be independent. Independence, again, relates to entangling financial relationships of a certain level that it causes you not to be, or could cause you not to be as objective in exercising your duty of oversight. Conflict is transaction specific. So you have to have a specific transaction that's being looked at by the board of directors, or that a contract that's being let. It is very transaction specific. I love the cartoon, thanks to the lovely Carrie Lavelle for getting it to us. I love the cartoon because no one sees the conflict of interest when it's theirs. And it's awful difficult to deal with it when it's actually your conflict of interest. Quickly, conflict of interest, again, is intended to protect from a specific transaction that might result in excess benefits. Again, nothing wrong with a conflict properly disclosed, properly handled, where the TPO pays fair market value. Nothing wrong with that. In this context, a conflict of interest are typically looked at with respect to directors and principal officers. There's always a duty, as we know, to disclose a conflict of interest. And then there must be a determination made by the board or some committee delegated by the board for this function to determine whether the conflict exists. And then the organization must have procedures for determining how they're going to address the conflict of interest and for approving transactions that fall under their policies. The IRS does have a model conflict of interest policy. And I would just note it's more stringent than state law, in my mind. If any of you have looked at the IRS model, it's very clear. You're to disclose your conflict of interest when it's a tax-exempt order, and then you're able to stay in the boardroom to say your piece, offer information, answer questions. But then the model IRS policy requires that person who has the conflict of interest to physically get up and leave the room and allow deliberation without their presence. And if you've ever been in a board meeting where you're actually dealing with a transaction where there is a conflict, it is a huge deal. Sometimes the room gets almost suffocating when someone is sitting there looking at all their fellow board members and there's a transaction on the table. So I think it's not mandatory, but I'm a real fan of the IRS model conflict of interest policy, because I think, going back to our little cartoon, it's really easy if you set up the right policies to say it's not personal, it's not about you. You need to get up, you need to leave, recuse yourself from the discussion, and as well as the voting. But not so easy if there's no policy in place, because then it becomes a personal decision someone is making with respect to a director, a person. I'd also kind of just note that in the state, and I've had clients sort of argue with me, in most state law it's not as stringent. Usually you have to disclose the transaction and be approved by a majority of disinterested directors, which leads you to the precise situation which I described earlier, where you do have someone sitting in the room and sort of monitoring how the dialogue, answering questions as they are, objections as they're raised. Last slide on this topic, and Pam will take up this conflict of interest in a little from a practical standpoint. They're not bad. They exist on all boards, and again, they relate to specific transactions. They should be addressed by clear policies and procedures. And one thing to keep in mind, both in the independence and the conflict arena, is that requiring your board members, requiring your officers to fill out annual disclosure forms where they list all the possible hotspots is a great way to kind of monitor not just whether you have a majority of independent directors, but also where some of these specific transactions are going to arise, where we're going to have policies. And with that, I'm going to turn it over to Pam.